Hello and welcome to this week's instalment of Nucleus Investment Insights. We've entitled today's presentation, How Low Will They Go? In reference to the Australian federal government bonds currently being bought up at an alarming rate and in prospect, of course, or in thoughts for future RBA cuts over the next coming year or so. So we thought we'd put this one together just to give a little bit of context of our thoughts on our holdings in the federal government bonds and where we think they're going to go next. So on the agenda today, we've got our key items being what happens when the safety trade isn't safe. We'll then look at bonds from an Australian context versus global perspective. We'll then look at some RBA tactics, what to watch for, and then of course implications for investment and the way that we run money every day at Nucleus Wealth. So without further ado, I'll welcome our Head of Investments, Damien Klassen. G'day, Damien.
Hi, Tim.
And we've got our Chief Strategist, David Llewellyn-Smith. G'day, David.
G'day, Tim. Damien.
Excellent. So we'll jump right into it. So we've got top of the pops, government bond. We'll look at some pros, Damien.
Yeah, so we've sort of hit levels now, sort of record low levels on a number of different government bonds within Australia for the Australian market. Having said that, you know, where we sit versus some of the global bonds is still significantly higher. But I guess I just wanted to take this step back and look, because you usually use government bonds as a safety trade in your portfolio. So you want that there as stability. Government bonds pay a fixed capital return. So depending upon which country you're in, but as long as you're in a country that sort of creates its own money and has control of its own currency, then if they give you a bond worth $100 in 10 years' time, you're getting $100 in 10 years' time, and there's a fixed amount of interest payments. So you're locked in. There's in terms of safety, you know what you're getting, when you're getting, and you know that the person, because they're creating their own currency, they shouldn't have a problem paying it back. There are other sort of investment risks out there about alternative assets and inflation and all these things, but for the purposes of the money you're getting, you know what it is. The issue is real rates are pretty close to zero. So we've got about 1%. So if we look at our 10-year bond yield at the moment, it's about 1.7%-ish. And Australia has an inflation target of 2 to 3%. So we're basically saying for the next 10 years, if Australia hits its inflation targets, then you've got negative real yields. Inflation itself is sort of running about a similar level. So and there is this big question about, can governments actually get inflation up to a certain level, or can the RBA get inflation up back into its band? And certainly in countries around the world are struggling to do so with the current tools. And so for a government bond, it's sort of this part about, they're in this strange sort of part where they're meant to be a safety trade, but they've got so low that now you're starting to look at them as just if you just get your capital back and if you can just stick with inflation, that, you know, most people would be happy. But the flips, so and over 10 years the returns look downright, you know, miserable. So if I say to you, you know, you've locked in, you're buying this bond, you're holding to maturity, so you're locked in at 1.7%. There's not it's not very attractive. But the question is, in 2 years' time, if we're sort of in a similar place to other people where 1% or lower, you know, there's a lot of countries with negative bond yields and even negative bond yields at sort of 10 years out, then maybe 1.7% at the moment looks like a bargain.
Pretty good deal.
Yeah. So you know, you've got this part where, so from a pro side, what the government bond is giving us is it's giving us this safety, and it's got some capital upside. So for example, if the 10-year bond went to say about 1%, you'd make 6 to, depending upon how fast and, you know, other things are going on at the same, and how quickly it goes, but you're talking about 6 or 7% return on the bonds in terms of capital. If you then wanted to take those bonds, sell the bonds, and go and buy equities with it, and that's the sort of idea for us having it in the portfolio, is that it's got this nice safety in terms of you going, well, I know over 10 years I'm going to get my money back, and I know when I'm going to get my money, and I've also got this capital upside part where if Australia keeps going the way it looks like it's going, and we follow the rest of the world down this path, then you've got this capital upside benefit as well. The flip side is that there are some cons as well. The cons are pretty much the same at the top. There's a fixed, you're not getting any extra in terms of your fixed capital return, your fixed payments, and they're really low. If bonds went to say 3%, so from 1.7, and we're just talking 10-year bond, and again, it sort of depends upon how quickly it happens and stuff like that. But you're probably going to lose. So the bond yield going from 1.7 down to 1 got us about 6 or 7% return. You'd probably lose twice as much if the bond yield went from 1.7 up to 3%.
Right.
So if it went sort of to the top of the inflation band. So basically a 0.5% real yield or 0% real yield if there's actually inflation out there. So inflation is your biggest concern at the moment, and there's a lot of people who are talking up. Inflation's lurking, it's sitting there, it's under your bed, it's just about to break out, and there's all these latent measures of inflation, and there's a lot of people who have very very long and detailed arguments as to why inflation is about to make this sudden return. Those people have had those same arguments for
a long time.
10 years, 15 years. Our view is that there are a lot of other factors that are sort of weighing down on inflation, and I'll jump across to David in a minute just to run through some of those things that are holding down inflation. But the issue with the government bonds is, as I spoke about, we're talking 1.7% yield. If there is any error in terms of inflation, and inflation does overshoot, then that's where we've got
to start winding out.
That's where you're going to be losing money on your government bonds if you're doing it as a trade. If you're doing it as I'm holding this to maturity.
Yep.
You don't worry about it. You know what you're getting out of it. But I think for our purposes, we've sort of got a series of bonds that we are holding for maturity as stability, with the option to switch into equities if equities sort of fall away. And then there's another part we're holding as this trade as the world comes to the realization, and that's been quite a profitable trade over the last 3 or 4 months in particular. We still think there's some scope to, well, it's probably run ahead of itself at the moment. There is scope over the longer term for that to keep going. And your other issue is there's increasingly modern monetary theory,
which is code for printing money.
Yeah, yep. I think there's some interesting. Yeah, lots of it's everywhere at the moment. I think the pithy statement is it's neither modern nor monetary nor a theory, but it's certainly getting more and more adherent. And in the end, it's basically a fiscal, as you said, it's a fiscal spending. And we know that we've run out of room on the monetary side, and we know we need some fiscal spending. So however you want to call it, if you do see a decent outbreak of that fiscal spending, then that's where the real issues will come for because we will see inflation return. And so, but maybe it's worth tossing over to David for his thoughts on some of the key reasons why we think inflation is going to stay low.
Yeah, sure. Oh, Dave, have you got a couple of things to say on this one?
Yeah, sure. There's probably two ways of breaking this up. The first is the structural and global forces that are driving disinflation and lowflation. The first one is just peak debt, where various segments of the private sector are saturated with debt and need to deleverage, and some of them have been through that already in various countries where in the US, for instance, households deleverage, but its corporate sector is now extremely over leveraged, whereas here it's the reverse. But that peak debt in a debt-based monetary system obviously means that it's difficult to return any kind of consistent or sustainable inflation pulse. Second one is inequality, which sets us up for a demand deficit or an oversupply in the economy. And that is when you have too much income and wealth, owned by too fewer people, which we've certainly got in the United States and increasingly in Australia as well, most particularly by the housing market. Then you end up with a situation where a lot of that wealth and income just can't be spent because there's just not enough people who have it, and those who have the marginal propensity to spend it, those further down the lower economic strata don't have enough to spend. So again, you have a structural situation where insufficient demand cannot support the oversupply in the economy, and that is deflationary because you have too many goods competing for too little demand. And the third one is probably the ongoing surge in automation globally, which is kind of tied with productivity as well. These are the third and fourth ones where we've had a long period of low productivity, which means that there again has been little income to share between corporate profits and labour, which has again resulted in demand deficit on the labour side. And then you've got automation, which is kind of projected to ramp up as robotics and AI come on stream over the next decade or two. And again, that's going to cause to some extent rises in unemployment, etc. Although I'm more hopeful on that side that might actually be the solution to some of these issues, because it should ultimately increase productivity and increase incomes. And as long as you're not in a circumstance where your political economy refuses to share that income, which places like the US are, and Australia is increasingly as well via its immigration program, which tends to keep Labor on the back foot. Not Labor the party, but the labour market in general, then the productivity gains that come out of those automations should actually lift income and help cure your demand deficit over time, but only if you're in a circumstance where those gains are shared. So basically a lot of big headwinds for inflation structurally. Then you've got the more particular issues in Australia where that peak debt scenario is very critical at the moment in a cyclical sense, with house prices falling quite quickly. And we see the headwinds for those house prices as very severe and quite unprecedented, with macroprudential, the post-Hayne Royal Commission reforms, particularly around the HEM, the household expenditure measures, leading to a structural tightening in credit. And then the wealth effects around that, of course, creating an output gap or a demand deficit in Australia, meaning low inflation on that front. And then, particularly for Australia, China's transition as well, as it steadily goes ex-growth, owing to its own over-indebtedness, and that, really directing what is only a terms of trade correction that is halfway through. That is commodity prices, which came off their record post-GFC highs and fell very heavily into 2016, but then got a little bit of a fiscal bounce. But as China continues to see its growth fall, as it can't continue to ramp up those levels of debt via stimulus, then commodity prices are going to keep falling, and we see them going a lot lower yet. The key ones being the steel inputs of iron ore and coal, and that's going to create an ongoing income shock for Australia. Basically, the national pay packet will continue to be cut for the next decade, and again, that's very deflationary. What we've described as a lost decade has probably another decade to run, and everybody will be scrambling to find any income they can. So you've got a structural context of low inflation globally, and then Australia has some quite severe cyclical deflationary headwinds as well.
Yeah, sure, David. Well, look, thanks for that, and definitely a well-rounded picture of some reasons why to still hold bonds. We might jump into the next piece, which is the bit of context, I guess, really around central bank rates, both with Australia against the rest of the world. And it looks like here we've got Australia in blue, Norway in red, and green for Canada, if for those watching along. So what have we got to note here, Damien?
Yeah, just got a long history of the three countries. So these are three developed markets, all what we call commodity currencies, in that they're quite large exporters of various commodities. Canada was probably more similar to Australia, but over time added a lot more oil and gas. Norway has always had lots of oil and gas, and Australia quite recently has been adding a lot of gas in particular. And so the currencies, the long-term interest rates, as you can see, are pretty similar between all three. They're sort of buffeted by very similar forces. Yes, there's short-term local sort of domestic factors or commodity-specific factors which affect them. But as you can see over the longer term, very similar drivers. You'd expect that the
similar situations.
The bond rates. We'll go through similar stages. And so then I've sort of focused in though on the last 10 years where the Australian bond rate has been a lot higher than the other countries. And a lot of that's been the China stimulus following the financial crisis, in that that's kept iron ore prices quite high and coke and coal prices quite high, and thermal coal as well. And Australia is a very big producer of that. And, it's this thing about proximity. Australia sort of services the Chinese market. Canada is a lot more tied to the US market. And so I think what we're seeing is that, and what we're seeing on this one is, the Australian interest rates have been a lot higher than the other two currencies. They, in sort of 2016, both those currencies, both the Norway and Canada sort of hit sort of the 1% level for the 10-year bond rates. Economies were going more slowly because they didn't have that sort of the China demand sort of underpinning their economies.
Sure.
But that sort of leads back to the question now: is that sustainable forever? And in our view, that's not a permanent. And it might be, it's not a permanent situation, and it might actually be, as David spoke, there's reasons for that to come back. And so what we're looking at in terms of where we sit versus those other currencies, we're still a decent bit above both those, but also above the lows that we sort of saw in both those economies when they were having more severe problems back in 2016. And so I guess the question is, if Australia's going into a housing crash and we've got all these other headwinds of our own, we would think that's at least enough to offset any benefit from increased Chinese demand. And if Chinese demand falls flat, well, then our bond yield should be at the same level or lower than these other countries most likely. Depending upon lots of other economic factors, but in a broad sense, there's sort of no reason why we can't see our 10-year bond rate sort of hitting similar levels to what we saw from these in 2016.
I'll just add a couple of things on that. Vis-a-vis China, one, the stimulus that they've done to date is not enough to see any kind of roaring rebound. It's really more about stabilisation. So, in that sense, I wouldn't think that commodity prices are likely to take off. And secondly, the Vale accident has already sent them so high that unless China excuse me, really does hit the gas in a way that it hasn't as yet done, then, the stimulus to date will actually see those commodity prices fall because, as Vale sorts out its supply issues slowly but surely, you're actually going to see, iron ore at the mid-80s is in the throes of what would normally be a rampaging Chinese stimulus. I mean, it's already priced. So you're still going to have a quite decent Chinese stimulus without it being ripping, and these commodity prices are going to have to fall, not rise. They're already priced for perfection, absolute perfection, and it's much more likely that we're going to fall short of that.
So then if you jump to the next part, and just in terms of a relative sense, is just comparing to some of the other economies that have led the way. And these are some of the key manufacturers. I've just picked out the Japan and Germany, but if you look through Europe, you see a pretty similar trend across most of those, but across most countries there. And basically, what you're seeing is that the 10-year bond rates are at zero or negative, and so. We're not sort of playing for a negative yield within Australian bonds. You'd need quite a severe downturn and a recession and possibly other global things falling out globally. It's certainly within the realm of possibility, but I think it's not something as an investor you'd sort of say, well, I'm buying them now because I think 10-year bond rates are going to zero, which is sort of about a negative 2.5% real yield over the long term is pretty severe. Australia does have a higher inflation target than a lot of other countries. Yep. So having said that...
Do you think that might be due for revision though? Or?
Well, I think most places would and World Bank people would actually prefer to have higher inflation targets.
Absolutely.
But having said that, if you can't hit your low inflation target, raising your target and
moving your target,
and not hitting that as well isn't going to make that much difference.
Sure.
But you'd like to think though that you can maybe get some people. Oh, sorry, you go, David.
Sorry, I might add that at the moment, the RBA and its satellite of economists, for want of a better word, are very deflation-minded at the moment. It is actually possible that these idiots will lower the inflation target directly into a deflation shock, which would be absolutely mad, and certainly not the base case. I don't think government would be very happy about it, and it would certainly have to go through them. But there are a number of quite eminent voices arguing for just that, and they really just haven't cottoned on to this structural low-inflation environment. But I expect they will in time.
Yeah, well, that's probably a good segue into some of the RBA tactics and some of the things, I guess, that we can look at what they can do, what they've done in the past, and then what they can possibly do in the future to sort of to try and attack this problem. So in the past, we've seen the traditional measures is basically cutting rates. So demand's low, you cut rates, you blow debt bubbles, and you loosen credit standards, and then you hope that everything comes back. And when your debt bubble goes up, then you start winding things back to make sure it doesn't get too far out of control, and off you go. The issue we've got is we've blown some pretty big debt bubbles. We haven't really got a big government debt bubble in Australia, but we've blown some sort of world-leading private debt bubbles.
Yep, household debt. Yep,
and we've loosened credit standards already as pretty much as they were as loose enough that we had a Royal Commission that sort of came in and said, hey, what are you guys doing lending people money that they can't afford to pay back? So the sort of traditional measures of trying to get demand sort of going have been used, and so and the loosening of the credit standards looks like it's legally now being pulled back because the courts have actually said, well, you can't lend money to people that they can't afford, so they've sort of put the clamps on that. So the question now is what else can you do? Now, fortunately, Australia, the rest of the world's been through a lot of this stuff, so we've seen what the steps are. But the first step is the first step actually is once you've finished your rate cuts is starting to get into quantitative easing. Yep. And there's a number of different methods you can use. There's some. Basically, you want to try and get money out into the economy. The euro is using slightly different methodologies to the US, but the effect is pretty much the same. Japan's even out there buying stocks and basically anything that's not nailed down. They're out. The central bank's out there buying. We'd like to think that after 20 years of Japan trying it and 10 years of everywhere else trying it and pretty much failing to get inflation going, that you'll start to look for other tools. There's certainly a competitive currency devaluation game going on out there because the lower you can get your currency, the better it is for your economy. You can stimulate some demand that way. Australia hasn't been playing that game at all. Arguably, we've been talking it up rather than talking it down. We certainly could move into that. And then there's the sort of quantitative easing to get money out actually directly to the people, which was tried a little bit in Japan. And there's a lot more sort of discussions going on about that, about what can be done. But our sort of take on the RBA is that they still sort of sit very much behind the curve. Yep. They've been fighting tooth and nail to, been telling everyone rates are going up for years now as this whole thing's played out. And our take is that, as we've been saying all along, is that they've misdiagnosed the problem. Is that they still haven't got to, until they get to that diagnosis and work out that, hey, we're actually, we're not dealing with just a short-term demand, and it's not just an animal spirits, and if we can buck everyone up and get them to go out and borrow some more money, everything will be fine. That then you can actually start worrying about, what can they actually do in terms of some of these processes. So historically, so they have to turn it around. Historically, the RBA has been quite data driven, and when they've sort of been slapped in the face with, you used to think this, and now the data's telling you that that's definitely not right, they do tend to flip around. The question is, will they do it this time or not? And so at the moment, the ship's starting to turn, but it's I think its captain's pretty reluctant. And David, I'm sure you've got a few more thoughts on that. But I guess my overall bit is that the rest of the world's already been through this process. We've seen what works and doesn't work. So you'd like to think that
we've got a blueprint.
We've got a blueprint.
Yeah.
Yep. Let's not follow the European one. Let's follow
or try something
the US,
different anyway.
Or let's actually be thought leaders and go for something new. But that doesn't seem to be. We seem to be following very much the orthodoxy.
Yep. David, your thoughts?
Well, yeah, I mean, there should be in popular conversation a counter definition to thought leadership, maybe thought lagging, and the RBA would be the perfect representation of that. They've been terrible since the GFC in terms of getting ahead of these various structural shifts and trends, and I don't think that's changed at all. Post-mining boom, or during the mining boom, they were busy fighting a 1970s inflation breakout that was never coming. After the mining boom, they were so busy panicking about bailing out their own screw-up with mining that they refused to countenance what was coming in globally, which was macroprudential tools to control the fact that they were slashing interest rates, and as a result, they blew another leg up in what was already a gigantic property bubble. And as that mining bust played out and diminished, they were left with the housing bubble, which they're now trying to talk down. And now they're overcooking that as well by refusing to cut rates and give it some assistance on the way down, because, the headwinds, the macroprudential headwinds, if you like, which takes in both the exit of Chinese dough plus the Hayne Royal Commission tightening, is very, very severe. And the RBA has misdiagnosed that again because it's so busy looking backwards at its last bubble, which it doesn't want to blow up again. So they're not thought leaders, they're thought laggers. Their methodology is also lagging. As Damo says, they're data-driven, when we already know that, some of the most crucial data, I'm thinking of labour markets in particular, is very lagging, and they don't want to cut until they see that go.
Absolutely, and that was what we spoke with Damien from Credit Suisse last week about that and about the whole jobs. The jobs indicators are about a 6-month lag on the rest of the economy, and then once you actually cut rates and start these things, you've got another lag of 12 months or so before it actually really starts to hit. So it's sort of basically you're trying to drive a car that when you steer, it doesn't start changing direction for another couple of months, and in the meantime you're busy looking in the rear vision mirror trying to work out when you should be steering.
Yeah, in essence, when the writing's on the wall, it's well and truly too late almost.
Yes, exactly. Yeah, one other thing just to note quickly on the RBA tactics is there's a bit of this reliance on fiscal, and what I mean by that is the government spending, and we do have an election in train very shortly, and there's a bit of spare money from higher commodity prices that's going to be thrown around, and so there are some thoughts that maybe that will actually help. The biggest issue for that from what we've seen elsewhere overseas is that often what happens at the state level will offset what happens at the federal level. So yes, federally there is a desire to get out and spend this money and to get the economy going and to tax cuts and all those types of things. But if at the same time what we're seeing is states that do a far greater amount of the actual day-to-day capital expenditure and things like that, if they're all pulling back because the household receipts, so the stamp duty receipts are much lower, which they are much lower, and we know that's only going to get worse, then that quite possibly will offset a lot of, if not all, the benefit you see from fiscal. And we've seen that, right around the world as other countries have been through this same process.
Sure. Okay, very good. So what are we looking out for? What's to watch for going forward, Damien?
Yeah, so I've got sort of 7 things that are on the list. I mean, and a lot of these are all, if you get a little bit of movement on all of them, might cause us to pull back our bond weights. A lot of movement on one, but and so it's this combination of a whole bunch of these different things that can make a difference. So the first one that we're looking for is that, we spoke about it a little bit earlier, that 2016 commodity country bond yield lows. That's sort of our line in the sand about saying, well, we know other countries in similar environments and with potentially within similar environments sort of hit the 1% level. So that's sort of when we start getting close to that, we know that we need to start being a bit more careful and be winding back our positions. So
that's sort of the lower bound, you think, of Australian, of the out rates in Australia?
It depends on how bad some of these other ones get. Okay. So, but I think it's a reasonable marker to have your eye on, is saying whatever weight we have right now, we won't have the same weight at when the bonds hit 1% unless a whole bunch of these other things have turned really, really bad.
Okay.
And so, as we get closer to that 1%, we'll be scaling it back and looking for other things. So rate cuts and quantitative easing are highly likely. The sooner they happen, the more likely that bond yields don't get as low. So the longer it takes for those rate cuts to happen, and the longer after the rate cuts have run out of ammunition that it takes to get to quantitative easing, then the lower we'll expect those bond yields to go, because our concern is that once the housing market gets out of control and a lot of these things start to slip away, it's too late to go, and it's quite potentially it's already too late for rate cuts and quantitative easing. But if they're delayed even further, then there's other issues. Sure. The fiscal spend. So the more government spend, the better it's going to be for the point that we're getting to won't be as low. So if you're seeing lots of spending, we'll have to start reversing and selling our bonds a little bit earlier.
So when you say fiscal spending, so big infrastructure stimulus, what forms would they take?
Tax cuts, okay. Infrastructure. Maybe there's more on the health, maybe schools. Like there's a lot of areas you can do spending on.
Yep.
It doesn't really matter which area, as long as some areas will have better bang for buck. And so when they spend money in that area, especially if it goes to the lower income, and I think the Labor Party, which is looking like winning at the moment, but who knows? They've certainly got a number of programs sort of targeted at the low income earners, and that would certainly help stimulate demand.
Yep.
Throwing money, if you did a big sort of stimulus sort of a la Trump, where you give some nice big tax cuts to companies and to the richest people.
Yep.
That'll have an effect, but it's going to have far less of an effect if that same money was targeted at the lower income. That would have a far greater effect than giving tax cuts to companies and the already rich.
So effectively giving it to people that'll actually spend it.
Absolutely, yes. Housing crash. So the worse things get on the housing crash, the lower we'll see those bond yields go. The Aussie dollar is probably one of the biggest factors which would help ameliorate some of these problems. So Aussie dollar falls. If it fell quite dramatically, then all of a sudden Australian goods and services become a lot more attractive on a global perspective. That lifts demand for people who are wanting to buy us and wanting to hire people in Australia to run their Asian leg of their global companies and all those types of things. So the lower the Aussie dollar goes, then that's another sign that yes, I can start winding back on my bond yields. Having said that, the Aussie dollar's got some of those factors that David was talking about, but it's whether it be commodity prices that's affecting it, whether it be the fact everyone else is trying to get their currencies down as well to try and get demand up.
Do the same thing. Yep.
So there's a lot of factors at play there. Corporate debt, there's not enough time to go into this in detail, but basically the corporate debt load globally is getting up there. So it sort of tends to go through cycles. Corporate debt wasn't that high at the financial crisis. Most of the problem was within households.
Yep.
Yeah, and so that was where we saw most of the problems. Corporate debt's starting to get up there now, and so potentially, from a global perspective, that's one area that could be a global concern. And if you start to see corporate debt defaults increase, and then even locally Australian corporate debt, that's a sign that the bond yield can go lower.
And just on that point as well, obviously. People draw parallels to crises quite easily. So there's the GFC, US-style housing debt related. You could draw some parallels to housing debt in Australia. Household debt's at record highs, but probably one of the highest in the world. The question remains: is there sort of a GFC-style problem looming for Australia? Do you think it's going to be at that level? It's probably not going to be a worldwide problem like it was. What are your thoughts?
I think look, there's a whole bunch of different outcomes that we sort of consider. If you have a decent sized global downturn and the RBA a little bit late, then you could see a GFC style event happen to Australia in terms of severe housing downturn.
Yep. Stock market falls.
Big tick up in unemployment.
Yep.
If you got a number of those dominoes went at the same time, then yes, you could very easily see scenarios where you can end up in that case. I think there's an argument that central banks have been they know how they've got a few more kicks of the can.
Okay.
They haven't solved the problem. They don't really know what to do, but they know how to delay the problem, and we can probably delay the problem for a bit longer. And when I'm talking I'm talking globally. The problems can be delayed a little bit longer, and so that's I think that's probably a decent base case. Is that there's a few decent sized can kicks. Australia has a lot of problems, but they do tend to be isolated a bit more to Australia.
Sure.
But you do have that downside risk.
Yep.
And so you wouldn't. I certainly wouldn't discount a major crisis within Australia.
Okay, interesting. Finally,
and then finally, MMT, which is this modern monetary theory,
magic money theory.
Magic money theory, yeah. Pick whatever you like. In the end, it's an argument for governments to get out and print money and spend, which is, in our view, a far better way of actually getting out of this than the monetary policy, which has been tried for 20 odd years in Japan with no success.
Yep.
We've had 10 years globally with people trying various bits of monetary policy with no success. So you would hope that eventually somebody will say, well, maybe we should try something different. And even though there are people complaining about this, a lot of it's just fiscal spending, and let's just get out and do it.
And do you think there's a question, especially with magic or modern monetary theory, where it's obviously, as you mentioned, it's been used a lot around the world to varying levels of success. But is it a question of the quantum?
Sorry, when you say modern monetary theory hasn't been used,
okay,
to
so the QE as opposed to MMT, perhaps.
Yeah. So the basic steps that the central banks have been going through at the moment has been weak demand. Let's cut interest rates because that'll spark demand again.
Yep.
Then they've run out of interest rate cuts, and now some places are playing with negative interest rates, which lose a lot of its benefit. But so and it's clearly not successful anyway.
Okay.
So far, and I doubt it will be, but
okay.
There are people who believe we just need to get it more negative, and so there's that. There's quantitative easing, which is basically, okay, well, we're going to go out and buy assets to basically, if we can push down yields everywhere, then if you can only get 1%, 0.7% on your bond yield, Tim, you won't want to buy any bonds, and so you rush out and start up your own company and get some more demand going by creating jobs and blah blah blah.
Yep.
And that hasn't tended to be successful. The Japan's even gone down to the step of saying, okay, well, now let's start buying equities and buying other things to try and force people out.
Yep.
That hasn't been successful. So the next stage is actually saying, well, you need to print money, same as printing money, but rather than printing money and going out and buying government bonds and buying stock market
Financial
assets and stuff like that.
Yep.
Just give it to the people, or give it to the government, who will just cancel the government's debts so that they can then actually go out and spend more money.
Okay.
And so an MMT is a theory that sort of gives you cover to do that, and which is why it's in vogue at the moment, and there's sort of so much discussion about it. But keep in mind that there's a lot of heavyweight economists who don't want to change. They grew up, they won Nobel Prizes for monetary theory and all these the current system.
Yep.
They're not going to give up easily. It might surprise us as to how fast it happens, but chances are it's going to take a long time for governments to work their way around to sensible governments trying this as a genuine.
Genuine attempt. Okay, very good. And just finally, as always, we roll through some investment implications. So we've had quite an overweight holding and position in all across most of our portfolios in Australian federal government bonds since late last year.
Yep.
And that's paid off quite well up until now.
It's been good so far. Ideally, our plan, and best laid plans always. Our plan was that we'd roll into our bonds. We've got some foreign currency holdings as well. As the realization came that the RBA wasn't going to be raising rates, we'd see bond yields fall, which happened. We were hoping that equities would actually come off as well at the same time, and then give us a chance to switch from one to the other. We're still hopeful that'll happen. Yep. But we still think we've got scope on the bonds. So that's sort of our basic play for how we'd like it to go.
Sure.
The Aussie dollar's stayed very high so far, so we've still got that. We sort of feel as if we've the bond leg's working.
Yep.
The Aussie dollar is going nowhere. The equities leg, international's outperforming Aussie, but the Aussie really hasn't fallen, and so ideally we'll sort of end up with the Aussie dollar. Sorry, our international cash holdings giving us some benefit.
Yep.
Our bonds giving us some benefit. Equities falling, switching, and then riding the next wave. But I think at the moment it's obviously
too early to tell.
It's too early to tell, and you're in that problem is if your bonds do move even further, but equities don't fall, then maybe it's cash that's the
short-term
you just
cash.
have to look at a period and just say, well, I'm not going to make any money for the next little while because everything's so expensive.
Yep.
But I'd certainly be concerned. Yeah, we're certainly concerned about equities, and especially you're seeing weakening in Aussie earnings already, and the economy's still not looking good. You don't need too many pushes from overseas, and it could turn very ugly. So be very conservative on the equity side and sticking with the safety sort of trades on equities as well.
Okay, yep, fantastic. All right, well, look, plenty to think about there, and no doubt we'll be doing another bond one in the next few months, or maybe 6 months, just to sort of recap on where we've left off today. So, well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers.